Welcome to today's deep dive. We're just skipping the usual warm-ups today and jumping straight into the price action that is absolutely dominating the financial landscape right now.
Yeah, we have to. It's the only thing anyone is talking about on the desks.
Exactly. As we sit here on March 1st, 2026, I want you to look at your standard equity portfolio. You pull up the S&P 500, and it is sitting at this relatively flat 1% year-to-date gain.
Right. It's quiet, very sluggish.
Yeah, lots of sideways trading. But right next to it, operating in that exact same market environment, gold is having an explosive, just a face-melting moment.
It really is.
And I am not just talking about a mild risk-off uptick here. Gold price is sort of staggering 64% in 2025.
And if anyone thought that rally was going to cool off or, mean revert, they were dead wrong.
Completely wrong. It is already up another 18% so far in 2026.
It's a rate. Right now, it's sitting at $483.75 a share. That translates to a 72.9% return over the past 12 months alone.
Which is wild. And having $181 billion sitting in a dark, quiet vault doing absolutely nothing but looking shiny is, it's objectively hilarious when you think about it.
It is a bit ironic, yeah.
But right now, that shiny rock is beating out the greatest tech innovators on Earth. Those are software-level returns, but we are talking about physical heavy metal here.
Exactly.
So here is our mission for today's deep dive. We are unpacking the SPDR Gold Trust, exploring the massive macro forces from a towering $38 trillion in U.S. sovereign debt to major geopolitical escalations that are driving this unprecedented rally.
The big structural drivers.
Right. We're going to figure out if this is just a temporary market panic or if we are witnessing a fundamental structural shift in how institutional capital is allocating risk.
I'm glad to be diving into this with you today, because you're right, the sheer scale of those returns is forcing everyone to pay attention. But we can't just fixate on the what today, that dramatic price action. We really need to focus heavily on the why.
The underlying mechanics.
Yes. Specifically, how physical gold, and by extension the SPDR Gold Trust, acts as a critical hedge in times of intense fiscal and geopolitical crisis. When traditional risk assets stall out, capital looks for a safe harbor.
Always.
Understanding the mechanics of that rotation and whether it's sustainable is essential for anyone trying to navigate the complexities of this 2026 market.
Okay, let's unpack this, because we need to look under the hood of the SPDR Gold Trust itself before we talk about the macro environment pushing it higher. This isn't a mining operation, right?
No, not at all.
It's not a company trying to optimize its supply chain or drill new exploratory wells. It's a completely non-operating entity.
Exactly, and it's a crucial distinction to make. The SPDR Gold Trust doesn't have a CEO trying to aggressively boost quarterly guidance. It has zero debt on its balance sheet, and it generates absolutely no traditional revenue, no dividends, no free cash flow.
None of the usual equity metrics apply.
Right. Its sole singular purpose is to track the spot price of physical gold bullion minus a 0.40% expense ratio. When you buy a share, you are essentially buying a fractional, legally backed representation of physical gold sitting in a highly secure vault.
So the vehicle purely captures direct price appreciation.
Precisely.
And the scale of that vault is almost hard to comprehend. We are talking about $181.29 billion in assets under management. That is a staggering amount of wealth centralized in one specific exchange-traded product.
It is, and that massive AUM brings us to a critical concept for this specific trust, which is its competitive moat.
Yeah, let's talk about the moat.
What's fascinating here is that the primary moat for the SPDR Gold Trust isn't some proprietary algorithmic trading strategy. Its moat is entirely based on its pioneering scale and its unparalleled liquidity.
Because it was the first, right?
Exactly. It was the very first U.S. gold ETF launched back in 2004. Because it has that first mover advantage and has amassed that $181 billion footprint, it is the undisputed heavyweight champion of gold trading vehicles.
I hear you on the liquidity, and I know the 2004 launch totally revolutionized how retail and institutional investors access the gold market. But I have to push back a bit here.
Sure.
Paying a 0.40% expense ratio when a competitor like GAU charges just 0.18% to hold the exact same physical... that is a tough pill to swallow. We are talking about more than double the fees.
You're not wrong on the math.
Right. For a retail investor holding this over a 10-year horizon, doesn't that fee drag severely eat into the returns? Does the liquidity actually justify that massive premium?
That is a very fair critique, and it's a debate that happens on trading desks every single day. If you are a retail investor buying 10 shares and locking them away for 20 years, then yes, the lower expense ratio of a competing fund might make more mathematical sense.
It adds up over time.
It does, but you have to look at how the smart money uses this vehicle. The SPDR Trust's massive trading volume fundamentally minimizes the bid-ask spread. Because there are so many buyers and sellers constantly transacting, that spread is incredibly tight.
So superior execution offsets the fee for the big players.
Precisely. If an institutional manager needs to move $50 million into gold by the end of the trading day, they cannot afford a wide bid-ask spread.
They get killed on the entry.
They really would. A wider spread on a thinly traded, cheaper ETF could cost them far more in execution slippage than they would ever save on a few basis points of expense ratio. The SPDR Gold Trust allows massive capital inflows and outflows without wildly distorting the underlying share price.
Which is critical in a panic.
Very critical. In a highly volatile market, that kind of flawless, immediate tradability, the ability to get flat on a Friday afternoon before a long weekend, is worth its weight in gold, no pun intended.
Nice one.
That liquidity really is the ultimate defensive moat.
Here's where it gets really interesting. We know the mechanics of the ETF now, and we understand why the big money uses this specific vehicle. But we need to map out the current 2026 macro landscape.
Let's do it.
Why is this massive $181 billion vault suddenly seeing such an explosive, violent surge in value right now?
Well, to understand the velocity of this move, we have to examine the macro storm currently brewing globally. We are operating in a severe risk-off environment, and the most immediate catalyst is the geopolitical escalation.
The headlines are inescapable.
They are. The capital markets are intensely reacting to the U.S.-Iran war escalation. Specifically, we're seeing the fallout from Phase 1 of Operation Epic Fury and the ongoing, highly volatile military posture in the Strait of Hormuz.
And market mechanics are inherently cold. Regardless of the complex politics or the foreign policy decisions behind Operation Epic Fury, the capital markets are simply reacting to the sheer uncertainty surrounding one of the most critical energy choke points on the globe.
That's exactly it. The market doesn't take political sides. It evaluates risk. When there is a military conflict of this magnitude, particularly in regions that dictate global energy supplies, traditional risk models just break down.
Because you can't model for a sudden blockade or a major strike.
Exactly. Investors fundamentally despise uncertainty. They can price in bad news. If they know earnings are going to be down 10%, they adjust the stock price. But they cannot price in the unknown of a kinetic war.
Right.
So they aggressively pull their capital out of high beta risk assets and park it in the oldest, most historically reliable safe haven known to human history. And as we just discussed, the SPDR Gold Trust is the fastest, most liquid way for the market to execute that safety trade.
But the geopolitical shock is really just the match that lit the powder keg, isn't it? If we look at the data, the structural foundation for this massive gold rally seems to be rooted right here in the domestic U.S. economy.
If we connect this to the bigger picture, you're absolutely right. The conflict in the Middle East is the immediate spark, but the fuel is our domestic fiscal crisis.
Let's talk about the debt.
We have to. We are staring down a U.S. national debt that has officially breached $38 trillion.
$38 trillion. It's almost a fake number at this point.
It feels like it. And on top of that staggering sovereign debt load, we are running a fiscal 2026 deficit of over $1 trillion, alongside a continually rising M2 money supply.
It is the classic definition of fiscal dominance. When a government is forced to issue that much treasury debt and run trillion-dollar deficits just to keep the lights on, the intrinsic value of the underlying fiat currency is directly threatened.
Completely.
Capital is naturally going to flee to an asset that a central bank cannot simply keystroke into existence.
Exactly. Gold is acting as a premier, highly liquid hedge against currency debasement. And to complicate matters for the underlying dollar even further, we have to look at the latest inflation metrics.
The PPI data.
Yes. The Producer Price Index data recently came in much hotter than expected.
With PPI coming in hot, wholesale inflation is clearly sticking. That puts the Federal Reserve in an incredibly difficult position.
It forces them into a corner. Because inflation is running hot at the wholesale level, the Fed is largely trapped. There is widespread consensus now that they will be forced to pause their interest rate decisions.
They can't do anything.
Basically. They can't aggressively cut rates to support the broader economy because inflation is rebounding, but they also can't easily hike rates when the Treasury is trying to finance a $38 trillion debt burden.
The interest payments alone would be catastrophic.
Exactly. So, to summarize the macro environment for you listening, you have a major kinetic war affecting global shipping lanes. You have a historic sovereign debt burden. You have massive deficit spending during a period of economic expansion. And you have sticky wholesale inflation paralyzing the central bank.
It is quite literally a perfect storm for physical gold.
It is. And what's crucial to understand is the market internals driving the price right now. This isn't just retail investors getting spooked by a headline and buying a few shares on their brokerage app.
No, the scale's too big for that.
Right. We are seeing massive institutional flows. The smart money is actively and aggressively piling into this trade.
It's fascinating to see the actual names behind these flows. We aren't just talking about anonymous algorithmic funds here. Legends like Paul Tudor Jones are heavily backing this trade.
And Ray Dalio, too.
Yes. The filings show that Ray Dalio, one of the most successful macroeconomic investors in history, currently maintains a massive 15% allocation to gold.
15% is huge for a fund of that size.
It's massive. When institutional titans are moving billions into vehicles, like the SPDR Gold Trust, it signals something much deeper than a short-term hedge. They are positioning for a fundamental macroeconomic regime change.
That is the key takeaway. And if you look at the recent data published by the World Gold Council, it confirms this exact shift.
What are they seeing in the flows?
Well, the current market sentiment is overwhelmingly bullish naturally, given the price action. But the Council's analysis emphasizes that this strength reflects a deep structural need for risk protection, not just wild speculation.
I think that distinction is critical. We aren't talking about a meme stock craze here.
Not at all.
A structural need implies that massive institutional portfolios, pension funds, and endowments woke up in 2026 and realized their risk models were fundamentally broken.
That the old playbooks didn't work anymore.
Right. They realized they were drastically underallocated to gold given the new realities of sticky inflation and geopolitical instability.
Precisely. They are rapidly rebalancing their portfolios to survive this specific high inflation, high debt environment. It is a calculated defensive maneuver.
It just so happens that this specific defensive maneuver is currently generating 72.9% annual returns.
Which nobody is complaining about.
Exactly. Now, alongside that structural institutional buying, there's another market mechanic at play here that is slightly more speculative, but absolutely vital to understanding why the prices move so violently.
It's a squeeze.
The squeeze. The data points to a massive short squeeze potential.
Yeah.
Now, usually when you follow the markets, you hear about short squeezes in the context of struggling, highly shorted retail companies or low-float tech stocks.
Right, the typical Reddit darlings.
Yeah. To see short squeeze dynamics play out in a $181 billion macroeconomic asset like gold is wild.
It really raises an important question about how capital markets function during a regime shift. While gold is largely utilized as a long-term defensive hedge, there are always speculators and macro funds that bet against it. There were plenty of short sellers who looked at the high interest rates over the last year and bet that gold, which yields absolutely nothing, remember, would crater.
Because traditionally, when Treasury yields are high, holding a non-yielding asset like gold carries a massive opportunity cost. Why hold gold when you can get 5% risk-free from the government?
Exactly. So they shorted it, expecting the price to drop as rates stayed high.
But the macro environment shifted right beneath their feet.
It did. When gold prices spiked 64% in 2025, completely defying those traditional interest rate models, and then continued surging another 18% into early 2026, those short sellers found themselves deeply underwater.
And when you're short, your losses are theoretically infinite.
Right. As the price rips higher, their prime brokers issue margin calls. A short squeeze happens when the price rises so aggressively that these funds are forced to buy gold simply to cover their losing bets and exit their positions just to avoid total liquidation.
So you have structural buyers, like the Dalios and the pension funds, naturally accumulating the asset. And then you have panicked short sellers forced to buy the asset at the exact same time just to survive.
Both sides are hitting the buy button.
Right. That forced buying artificially inflates the demand side of the order book, driving the price even higher, which in turn traps even more short sellers at higher levels.
Exactly. It creates a vicious feedback loop. And the analysis right now notes that the short squeeze potential in the gold market remains considerable.
So we might not even be done.
We might not be. If that bearish positioning aggressively unwinds, the upside velocity for the SPDR Gold Trust could amplify far beyond what the underlying macroeconomic fundamentals would suggest on their own.
Okay, we've painted a very vivid, incredibly bullish picture here. We have legendary investors validating the trade, a perfect macroeconomic storm of debt and war, and the underlying mechanics of a massive short squeeze adding rocket fuel to the price.
It's a compelling thesis.
It is. But part of the mission for this deep dive is to look at the whole board. We have to play devil's advocate. For you listening, it is crucial that we establish the bear case and look at the risks.
We always have to check the blind spots.
Right. So if I am an investor looking at a 72% gain, what is the biggest immediate risk to this gold rally?
Ironically, the biggest immediate risk to the gold rally is peace.
Peace.
Yes. We discussed at length how the U.S.-Iran conflict and the tensions in the Strait of Hormuz are driving a massive risk-off fear premium into the price of the metal. If there is a sudden geopolitical de-escalation, say, diplomats successfully broker a resolution tomorrow, or a definitive ceasefire is announced, that fear premium vanishes from the market almost instantly.
The structural debt issues would still remain, but that immediate panic bid would completely evaporate.
Exactly. In that scenario, the market will likely experience a violent risk-on rotation.
Capital would fly out of the vault?
Aggressively. It would flow out of defensive safe havens like the SPDR Gold Trust and rotate right back into riskier assets, equities, growth stocks, higher-yielding corporate bonds. The sentiment could shift from overwhelmingly bullish to neutral, or even deeply bearish, very quickly as funds reallocate for a peaceful environment.
That makes perfect sense. The very catalyst driving the current panic buying is inherently unpredictable. And there's another major factor for the bear case that is rooted in one of the most fundamental concepts in finance: opportunity cost.
The long-term view.
Right. We've been throwing around this amazing 72.9% short-term return, but we have to zoom out and look at the historical data. Over the long term, gold compound annual growth rate, is CAGR, is roughly 8%.
Which is respectable, but
Historically, that significantly trails the broader equity markets. Over a multi-decade horizon, the S&P 500 has consistently proven to be the superior vehicle for actual wealth creation.
that is a vital reality check for anyone listening. Gold is historically a store of value. It preserves your purchasing power against currency debasement. But companies in the S&P 500 are dynamic, living entities.
They adapt.
They adapt, they innovate, they develop new technologies, they optimize their supply chains, generate free cash flow, execute share buybacks, and they pay dividends. Over a 20 or 30-year timeline, the productive compounding capacity of the broader stock market mathematically outpaces a static lump of metal sitting in a vault.
I think that is the crux of the debate.
Yeah.
Even though the SPDR Gold Trust is absolutely crushing the S&P 500 in this specific, highly volatile 2026 window, long-term investors have to weigh the opportunity cost of being massively over-allocated to gold when the broader market eventually finds its footing and resumes its historical growth trajectory.
It's all about duration. If you are hiding in gold for a decade, you are likely missing out on massive compounding equity returns. But if you are using it to navigate a severe, specific period of fiscal dominance and geopolitical risk, it serves its purpose perfectly.
It really is a delicate balancing act for portfolio construction. If you are listening to this and looking at your own asset allocation, it's about weighing that incredible short-term risk mitigation against the historical long-term growth of equities.
You don't want to be caught leaning too far in either direction.
Exactly. You certainly don't want to get so defensive and cash-heavy that you miss out on the eventual recovery of the broader market. But you also don't want to be entirely exposed to a $38 trillion sovereign debt crisis without some kind of highly liquid umbrella.
A very shiny umbrella.
Exactly. So what does this all mean? Let's distill everything we've unpacked today. Right now, the SPDR Gold Trust is effectively serving as an incredibly liquid $181 billion life raft.
That's a great way to visualize it.
And it is floating in a very turbulent macroeconomic sea characterized by an unprecedented U.S. debt load, massive deficit spending, sticky wholesale inflation, and severe geopolitical uncertainty in the Middle East. It tracks the physical metal flawlessly, and despite having a slightly higher expense ratio than some of its smaller peers, its massive scale and institutional trading volume provide the ultimate liquidity mode.
And my final synthesis of the data we've reviewed today is this. Yes, the historical multi-decade compounding growth of equities is higher than gold. That is an undeniable statistical fact.
Right.
However, the sheer magnitude of the current macro environment cannot be ignored or easily modeled away. The combination of massive structural underallocation to gold by major institutions over the last decade, the ongoing structural fiscal deficits, and the risk-off capital flows driven by military tensions suggest that this rally may have serious legs.
It's not just a flash in the pan.
No, the core conditions that created this perfect storm are still very much in play.
I want to leave you with a final provocative thought to mull over long after this deep dive ends. We've established that gold is currently transitioning from a simple inflation hedge into a mandatory structural pillar for massive institutional portfolios trying to navigate an era of severe fiscal dominance and rising geopolitical risk.
This massive shift.
It is. If that is true, we have to ask a much larger question about the future of investing. Is the traditional 60-40 portfolio of stocks and bonds dead forever?
That is the trillion-dollar question.
Literally, if sovereign bonds can no longer provide reliable protection against inflation and debt debasement, has the fundamental blueprint for asset allocation changed right beneath our feet? It's something to seriously consider as you look at your own strategies moving forward in this new environment. Thank you so much for joining us on today's deep dive into the source material. We will catch you next time.
Thank you for listening.